beginning, I said there were bubbles. Canada, for the most part, escaped the worst of the dot-com bubble. I mean, we had Nortel networks, but compared to what happened in California, that was small stuff. I said that notwithstanding the write-downs that my former bank and some others did, Canada really was not hurt badly by the subprime mortgage bubble like other countries and financial institutions. But when it comes to the carbon bubble, we're right at the epicenter of that bubble, because we have defined the oil sands not only as a sustainable project, but as the engine of economic growth. In fact, it was only a year ago that the Globe and Mail was likening the oil sands to the building of the Transcontinental Railway that made Western Canada possible to join Confederation. They said it was a game-changing event, not just for Alberta, but transformative for the whole economy. That we were going to have Saudi Arabia-type revenues that through the federal tax transfer system would be spread across the country. Well, since then, we've gone from engine of global economic growth to epicenter of a made-in-Canada recession. Because in the first 2 quarters of the year, GDP in Canada shrank, and that wasn't because of some global recession, because GDP shrank for virtually one reason: the huge collapse in capital spending in the oil sands. And while we don't have provincial data, provinces don't publish quarterly GDP numbers like the federal government. You know, we know from a number of indicators that Alberta's recession is not mild. Alberta's going through one of its deepest recessions in the post-war period, because this engine of economic growth has turned out to be a huge economic liability. And in a world of decarbonizing economies, is really a stranded asset. Now, to what extent that's been recognized in the upcoming election and by other parties is questionable. Obviously, the Harper government that has banked the nation's economic future on the oil sands is very vulnerable, and Harper has always campaigned on his economic management strength. Well, a made-in-Canada recession caused by a huge implosion of capital spending in our so-called engine of economic growth obviously is a political liability to the Conservative government. But not to be partisan, you know, I think that the opposition, both Mulcair and the NDP, have not yet really come to terms with the nature of the problem. I mean, this isn't about adjusting corporate tax rates. This isn't about running trivial budget deficits. This is about a huge misallocation of capital, that we've put our eggs in the wrong basket. And, you know, in the economy, unlike the stock market, in the stock market, you can move capital from sector A to sector B in a nanosecond. You just sell your oil sand stocks and you buy tech stocks or manufacturing stocks. In the real economy, you can't just take billions of dollars sunk in an oil sand mine and all of a sudden turn it into an auto plant. It takes a much longer period of time for the economy to readjust than it does in financial markets. And that's the nature of the problem. The nature of the problem is that we've bet the house on a resource that the rest of the world is shorting. And no policy, no government is going to be able to change that. What is going to change that? Well, there's a term in finance called mean reversion. And what it basically says is that when things, like an elastic band, when you pull it out to its extremities, it snaps back. When you have a huge distortion in one direction, things move the other way. Well, in the last 10 years, we've had some huge distortions in the economy. All of a sudden, we've concentrated all of our investment in the oil sands. The Canadian dollar morphed into a petrocurrency because our trade and investment became so centered on the oil sands that our dollar rose with the price of oil. to the point where we went from 61 cents against the US dollar in 2002 to $1.07 in 2007. And in fact, it was only 2 years ago that we were at a parity exchange rate. The Canadian economy does not operate at those exchange rates. The oil sands could, because they were getting US dollars anywhere for their oil. So we saw, in the shadow of the oil boom, huge declines in other parts of the economy. Ontario, the province that I'm from, became a have-not province. Newfoundland became a have province because of what higher oil prices meant for the offshore oil industry. Saskatchewan, Alberta, the delineation between the haves and the have-nots was all about who had oil and who didn't have oil. And what really hurt Ontario and Quebec the most wasn't so much that we didn't have oil. It was that the petrodollar was taking the currency to levels that made huge swaths of the Ontario and Quebec economies uncompetitive. And we lost about 500,000 jobs. Well, the solution here is the currency going the other way. And always in resource booms and busts, and Canada has always been subject to the vagaries of resource cycles, the great safety valve has been the exchange rate. That when commodity prices, and in this case oil prices, collapse, so does the Canadian dollar. We've gone down to 75 cents. I think before all is said and done, we'll be trading at 70 cents or lower to the US dollar. And all of a sudden, these industries that were marginalized, like manufacturing, like film production in Vancouver and Ontario and Toronto that had to struggle with a parity exchange rate, all of a sudden, these are the industries that are coming back. And economic growth is once again shifting to the non-oil provinces. And economic growth is now starting to come, not from the resource sector, but from the other sectors of the economy that were severely damaged by the appreciation of the petrol currency. So, I think in some sense, we are on the mend here, and it's not about policies or governments. It's really about our safety valve has really been the currency, and I think that we're going to see huge swaths of the economy come back.